The big story right now, obviously, in the moment is the government shutdown. We're not getting any economic data. Importantly, neither is the Fed. This is contributing to a lot of uncertainty. We're not going to get inflation data like we were supposed to. And all likelihood next week, we didn't get the jobs report last week. We don't know what the labor market situation was in September. We have a pretty good idea from some of the private sector data, but not officially from the BLS. And the expectation in the markets, in this case, the betting markets, is that this shutdown is going to go on for quite some time. This is 21 days. The last time I checked, just before this call started, we were at 24 days. So things are moving in the wrong direction from the perspective of anybody who would like the government to reopen. This could start to cause some economic pain if we start seeing government workers missing 1 or 2 paychecks, even though in all likelihood, they're going to be reimbursed once the furloughs are over. Some of that economic activity that would have happened otherwise is going to be lost. We'll never quite get back to where we should have been if the shutdown goes on for, say, 35 days, like it did back in 2018 and 2019. One of the other sources of uncertainty is on the tariffs, which are in legal jeopardy. The Supreme Court is hearing a case arguing that the tariffs are not legal and that companies should be reimbursed for what they've paid so far to the government to import things from the beginning of the kind of onset of the tariff regime. This doesn't apply to every single tariff. Some of the tariffs are country specific or product specific after significant periods of study. Those are not considered emergency tariffs, but the bulk of the tariffs were enacted under an emergency statute. If that statute ends up being struck down or the tariffs end up being found to not be valid under that statute, a lot of this money could be reimbursed. And that's right now, $1 to $2 billion a day that's being taken out of the economy as importers pay the tariffs that could be put back into the economy. It could almost act like a stimulus. But obviously, it's creating a lot of uncertainty on the part of the companies in the meantime, and it was also creating uncertainty on the part of consumers who continue to expect higher inflation at some point. We just haven't seen that big spike yet based on the tariffs that have gone into effect so far. This is also complicating matters for the inflation outlook. The broadening of inflation is something that will not be welcomed by pretty much anybody, especially people at the Federal Reserve who would like to see interest rates come down. We are seeing a higher and higher percentage of goods and services reach and breach that 3% inflation threshold. So that means you're 1% above the Fed's target and moving in the wrong direction. And as inflation gets broader, it will become harder to tame and harder to make the excuse that it's going to be transitory or only affect a handful of goods that are being impacted by the tariffs. We are not yet at the maximum broadening of inflation that we saw at the peak in 2022, but we are as high as we have been outside of that period, certainly for the last several years. Ultimately, this is going to make things very difficult for the Federal Reserve, which met last month and decided to cut interest rates. There was some disagreement as to how much to cut, but they did cut interest rates 25 basis points. They're going to meet again on October 29th. Even if the government is not open by then, and they have to really be flying blind in terms of what to do about monetary policy. But you can see even before the shutdown, there was a huge amount of dispersion, uncommonly large amount of dispersion, both for this year and for next year, and really all years, all time horizons on the committee as to where interest rates should be. There's just not a central tendency on the committee right now for whether rates should be cut only once or twice more or a lot more times through the end of next year. And that's going to continue to create market uncertainty as well. There's people on the FOMC who are arguing that rates need to come down because policy is much too tight. There are people in the FOMC who are making a slightly different argument that the labor market is getting weaker, which we agree with. And that is one reason why we need to be a bit more cautious about keeping rates where they are. And we should be preferring to lower them. And there are people who are saying, but gosh, inflation is still 3%. How can we be cutting interest rates and loosening policy at a time when we haven't achieved our 2% inflation goal? The fact that we're not getting any economic data is not helping the Fed resolve this issue internally and is not helping the markets get a clear sense of where rates are likely to go next. Interest rate volatility has been uncommonly low since the government shutdown because there just isn't much information coming out that's directing people who own bonds or who want to make bets on interest rates to have any kind of idea of where things might be heading. So what we think is going to happen with the Fed is that they're likely to cut rates at least once more this year. There's a 90% chance priced in for an October rate cut. Something dramatic would have to happen in order for that not to occur. But what we always say is you really do need to see much higher unemployment to get a lot more rate cuts. The Fed right now seems willing to look past inflation as a concern. We'll get to some of the market implications of that on the next slide. But so far, there isn't the urgency to cut rates by 50 or 75 basis points based on a rise in unemployment. If we get a couple of jobs reports that show unemployment going to 4.5% or higher, we could see bigger rate cuts. But until then, it looks like it's going to be steady as she goes, a rate cut every meeting or two, which is about what the markets have priced in. Let's talk about the implications of a Fed that does not seem as geared into the inflation story as a concern and seems much more focused on cutting interest rates to get rates down in the name of helping the mortgage market and helping the labor market. This is showing you the AAA rated municipal yield curve today and 1 year ago, undergone what we call this zoo steepening. So there's been a bull market in the front of the curve as short-term rates have come down. It's been a bear market in the back of the curve as rates have come up. Kevin McIntyre did ping me to remind me, Kevin McIntyre is our municipal specialist, portfolio manager, strategist, to say that after September's rally, the long end of the muni curve has actually inched its way above the Mendoza line and is now positive in terms of total return for the year. But you can see in the last year, the yields on the long end of the curve, and not just the long end, but everything basically outside of 9 years all the way to 30 years, are significantly higher than they were. And that has happened in part, and we've seen the same thing with the Treasury market. It's happened in part because the market has less faith that the Fed is targeting inflation in a serious way at 2%. So where the Fed controls the yield curve is at the shorter end. They can make those interest rates go down, but they can't make the longer term interest rates go down necessarily. If anything, it looks like they may be tolerating a hotter economy over the long run, and that is going to make investors demand higher interest rates for taking longer duration. Go one more forward just to show you the opportunity in munis, where we think there is still a very good chance to pick up yield, especially for taxable investors on a tax equivalent basis. The muni index is giving you above 6% compared to the Treasury and the corporate credit index, where we've seen interest rates come down by more this year. The muni rates spiked during Liberation Day when there were liquidity concerns, and they've come back down, but they're still about where they were to start the year, whereas the other parts of the bond market, you've seen rates come down. So the attractiveness of munis is enhanced from the start of the year. It's one of the reasons it's one of our highest conviction areas for putting new money to work. Let's talk about one other thing related to this, dollar debasement. The big story in the first half of the year was the US dollar was getting weaker, less so in the second half of the year, but the types of assets that people hold as a substitute for cash, when there's concerns about the dollar getting weaker, those have tended to do very well. So we can go here from gold, which is obviously a very high profile way. It's had an excellent year. People look at gold as a substitute for cash when they're concerned that the interest rates available on cash are going to be lower than the rate of inflation. So just by holding money in a checking or savings account, you're going to actually erode the purchasing power of your money, and you might want to hold gold instead. Bitcoin has occasionally been correlated with this story as well, although you can see there's a lot more volatility to what's driven Bitcoin, or that greenish line, than has driven gold. And then if you want these kind of lower octane substitutes, real assets, diversified real assets, including commodities, including public infrastructure, public real estate investments, those have had a good year as well as kind of substitutes for cash, as has the TIPS market. And here we kind of put them on a spectrum for you, from the lowest risk, the less likely to lose principal, to the most likely, the highest volatility, and arguably the most kind of overvalued relative to its intrinsic value. These are the options for investors who are concerned about ongoing, not just dollar debasement, but an overall strategy of running the economy hot. Even if the dollar isn't depreciating, your money might be losing its value at the very short end if the Fed's cutting interest rates and inflation is moving up.